Welcome to the first part of our new video series where we explore the beauty of unconventional strategies. We'll start today with a classic price action pattern that many overlook, but when automated correctly, it becomes a powerful tool in your portfolio. Our first strategy focuses on the inside bar. The logic is very elegant. It represents a period of market consolidation. Technically, an inside bar occurs when the current candle is completely engulfed by the range of the previous candle, the mother bar. This means the current high is lower than the previous high and the current low is higher than the previous low. But why does this matter? Think of it like a coiled spring. The market is catching its breath, orders are accumulating within this narrow range, and energy is building up. When that spring finally releases, when the price breaks the mother bar's boundaries, it often leads to a sharp, explosive move. We are looking to capture that momentum right at the moment of the spring release. Now, let's talk about expectations. This is a volatility breakout strategy. Because we are playing for those big explosive moves, you must understand that we will encounter many false breakouts. Consequently, the win rate will likely be below 50%. But here is the secret. We do not need a high win rate to be profitable. By using a trailing stop, we ensure that when we are wrong, we exit quickly with a very small loss. But when we are right, we stay in the trend as long as possible. The goal is a high risk-reward ratio, RRR, where a single big winner covers several small losses. Let's dive into the configuration now. In StrategyQuant, start with a new stock picker strategy. For this backtest, we are using the S&P 500 data, a perfect environment for testing equity momentum. For our money management, we switch to a fixed amount. This is crucial for our analysis because it allows us to see the performance of the strategy itself without the distortion of compounding lot sizes. For the triggers, we use before bar open for entry and on bar close for exit because we want our stop orders sitting in the market ready to go before the session starts. If the price hits our level, we want to be filled immediately. Now, let's define the inside bar mathematically for the system. Condition 1. High 0 is less than high 1. Condition 2. Low 0 is greater than low 1. That's it. These two lines of code perfectly identify that hidden candle inside the previous range. Once this pattern is identified, we place a long stop order at the high of the mother bar. The order will remain valid for 1 bar, meaning it expires if the breakout does not occur during the next trading session. Our initial protective stop loss will be placed at the low of the mother bar. We are essentially saying, if the market proves me right by breaking upward, get me in. If it reverses and breaks the low, get me out immediately. To truly capture a trend, we need a dynamic exit. We'll implement a trailing stop based on recent price action. The rule is simple. We close the position if the price closes below the lowest low of the last 5 bars. This general exit allows the trade enough room to breathe during minor fluctuation, but protects our capital if the trend officially reverses. It's a classic way to let your winners run. Since we might have multiple stocks flashing an inside bar signal at once, we need a way to prioritize. we use a position score based on the relative compression of the spring. We calculate the range of the mother bar, high 1 minus low 1, and divide it by the range of the inside bar, high 0 minus low 0. The logic here is profound. The smaller the inside bar is relative to the mother bar, the tighter the compression, and the more explosive the potential breakout. By using this ratio as a score, we ensure our capital goes to the setups with the highest potential energy. With everything dialed in, we are ready to see the results. Let's hit the backtest button and analyze how the simple spring logic handles the reality of the S&P 500 market. Let's look at the numbers. Our initial backtest shows an annual return of approximately 10%, but with a relatively deep drawdown of 24%. When we analyze the equity curve, a major issue emerges in 2008. During that period of sharp market decline, our strategy generated a high volume of false signals. In practice, this actually confirms what we discussed regarding that trading psychology at the very beginning of this lesson. We will encounter more losing trades than winners. On the bear market, our coiled spring, how we call it, often released, but the breakouts failed almost immediately. However, the key takeaway is that despite a lower win rate, our few big winners still managed to cover the string of small losses and keep the overall profit curve in an uptrend. To clean up the strategy and avoid these high-risk periods, we will introduce a simple yet extremely effective filter. First of all, we are going to add a subchart spite.d. And then, based on added additional subchart, we want a condition. Close of our subchart must be above its 200-day exponential moving average, EMA 200. Let's run the backtest again and let's wait a bit for its results. And the difference is night and day. Even though we triggered fewer trades, we successfully eliminated the most painful drawdowns. The equity curve is now significantly smoother and more stable. That's the beauty of the inside bar. It's not about being right on every single trade. It's about filtering out the noise and waiting for that perfect moment when the market's energy finally releases in your favor. Let me know in the comments if you tried this before or if you are going to. And also, if you like this video, don't forget to hit like and follow. Thank you for your attention and see you next time.